Stuff.
Ebony? No,
Ebony.
Ebony and Ivory.
Friends, we're a couple minutes late, but we had to talk about some stuff. Lots happening here with Claudia Turcaz and her Turcaz team here at All Western Mortgage. I finally got you set up on this is your office. Remember when we did the when we checked us in the last few times? So hopefully that sticks this time.
Hopefully.
So, well, I haven't seen you in a long time.
I know.
You've been on vacation.
3 shades darker.
Yeah, you are 10 shades darker
Compared to you. Yes, I've been on vacation.
Yeah.
I'm fully refreshed, ready to work,
All right. So I wanted to come over today and talk about short-term rentals.
Mm-hmm.
Obviously, you heard, everybody's heard that Henderson has approved short-term
Airbnb.
rentals starting in October. That'll take place. And so it's kind of a big topic right now about, I think it's exciting, actually.
Yeah, I think it's
I think
great.
it's a good thing. And then had a couple questions from clients of mine that wanted some clarification on some things. So, first of all, short-term rentals.
Yes.
It's just an investment property,
Right.
correct?
Correct.
So how do you get a
For
short-term?
the most part, it is. It could be people that already are renting that property, right? Like they've already purchased it, they already have a loan, they're making a mortgage on it, they moved somewhere else, and so, the tenant left, and so now they want to do Airbnb, and so it's already done, right? But for somebody that's barely thinking about, okay, this might be a good investment for me, the Raiders are coming, and there's a whole bunch of stuff going on, I might be interested in possibly purchasing an investment property and turning it into a short-term rental like a Airbnb or even a long-term rental. So that would be considered an investment property, Kristen, and so it's different than a primary residence, right? So what happens with investment properties is that most of the time, most lenders will require a 20% down payment on an investment property. And so the requirements are a little bit different, but it's no different than qualifying for a regular mortgage. The difference here, and it's kind of more of a benefit, is that we can use rental income to offset the mortgage payment for that investment property.
What does that mean?
So that means that, for example, let's say that you are purchasing a home and let's just for the sake of argument, it's $200,000, and the payment on a $200,000 loan with 20% down is going to be $1,200.
Yeah.
Let's just say. Well, you're going to rent that property out for $1,500, right? Then what we do is that we say, okay, we're going to be able to rent this property out for $1,500, so we're going to allow to give that borrower a 75% rental income. So we'll take 75% of that $1,500 and use it as rental income to offset that payment.
Okay.
Because a lot of people think like, well, I won't qualify because I already have my mortgage and I already have other debt. Well, a lot of the times what people don't know is that we use rental income to offset the payment, and so you would be surprised. A lot of people do qualify. Okay.
And that's why I wanted to bring this up, obviously, because a lot of people don't think they can afford to invest in real estate, especially when they have their own mortgage. So that's a great point. What kind of credit scores are we talking for an investment loan?
So for an investment loan, it's the exact same thing, right? Because an investment loan is still a conventional loan.
Okay.
You can't do FHA, obviously, because it's not owner-occupied.
Yeah.
But on any conventional loan, the minimum FICO requirement is always going to be 620. However, and that's like a big but, is that the lower your FICO score, the worst interest rate you're going to receive.
Yeah.
And so the best rate is always when it's an owner-occupied home, right?
Mm-hmm.
So because you're living in it, they don't see the risk as much as, okay, it's an investment property, I'm not living in it, I'm basically dependent on somebody else making that mortgage payment, so the interest rates are higher on an investment property. And so I would hypothetically say that anything, if you're looking to purchase a second home or an investment property, 680 or higher has to be, that 680 has to be that magic number. It has to be higher than 680 for you to be getting kind of a decent interest rate.
So 680, and again, we're talking about credit scores. And guys, there are lots of companies out there that will say, you can get an investment loan for a lower than 680 or lower than 640. Just keep in mind, nothing is free. You're going to be charged, so your interest rate is going to be higher, which is fine. Just know that that's going to make your payment higher too.
That's correct. Yes.
and that brings us into a conversation around bait and switch, because there's so many, and I love Claudia because her and I have worked together. You know, it's been like 4 years.
Yeah,
I was
it's
just
been-
thinking
I
that.
can't believe that.
Yeah.
Time flies when you're having
Yeah.
We won't tell them how we met.
No,
Just
I
kidding.
know.
Just kidding.
On the motorcycle.
Yes, that's
yeah.
Yeah, we'll leave it at that. Harleys.
Yeah. A lot of companies will tell you these grandiose things that they can
Yeah.
do for you, and it's really when by the time you get in there and provide all the information, and a lot of the companies are even online companies, and they'll
Well, I was just going to
quote
mention
you,
that. I
yeah.
was going to say, you know, with technology now and everybody just kind of having that ability, right? Like you have it right there on your phone. And so a lot of online companies offer or advertise, you know, 3.25 or 3.5. And so, do those interest rates exist? Yes, but it's going to cost you, you know? And so they
What
don't,
does that
they
mean
don't
it's gonna
say that
cost
up
you?
front. They don't say that up front. So, for example, right now, let's say that the interest rate on an FHA loan is 4%, and on a conventional it's like 4.25. Okay, because for us a conventional is a little bit more expensive on the rate than an FHA is, but I'm advertising 3.5% on an FHA. Well, I'm off by about 0.5%. But I'm advertising 3.5% because I want my phone to ring. I want people to call me.
Yeah.
Because most people right now, if you purchased a house in the last 2, 3, or 4 years, your interest rate's going to be at least 4.5%, sometimes 5%. Because that's what we're seeing right now. Is we're trying to refinance people that bought just 2 years ago and they were at 4.5%, 5%. And so what happens is that they entice people by saying, "Hey, we'll give you 3.5%. We'll give you 3.25%," and it's kind of a lie. It's like a bait and switch. That interest rate does exist, but the borrower has to buy down that rate. So if a borrower has, and let's even take it a step further. So let's say somebody's trying to refinance a house and their FICO score is 625, and they have a 4.5% right now. Okay. And I pull credit and they're at 625, well, my interest rate is not going to go down that much, or the interest rate that I'm going to be able to offer them, because the interest rates are all FICO driven. And what that means is that interest rates are completely dependent on the FICO score that you have. So when we pull credit, we pull all 3 bureaus. We don't take the highest, we don't take the lowest, we take the one in the middle. And that's what we use to determine what your interest rate is going to be when we go and price out your loan. So if that
On
person,
all loans.
on every single loan. So
Yeah.
if that person's rate for me, you know, is okay, at par, this person says here that the rate that I have to give this person is 4.5. If that person wants to lower it to 4%, now that person is what's called buying down the rate. So it's costing that person money, out of pocket money, or if we're doing a refinance, sometimes you can incorporate that into the loan. But again, these are things that aren't being disclosed to the customer.
Yeah.
They're just being told, yes, I can give you this interest rate, and then you get all into it and you say, awesome, and then when you're sitting there signing disclosures, the loan estimate comes up, and if they're honest, they're going to tell you, hey, here are the fees. And if they're not, they're just going to say, okay, you're out of pocket. There's no out of pocket. This is your new loan amount. This is your payment. And if the payment dropped, that's what most people are looking
Yeah.
for anyway, right?
Yeah.
They're not knowing how much is it costing me. Well, you owed $150,000, but guess what? Your new loan amount now is $160 because we incorporated all of those fees into your new loan. But you're happy because your payment still went down, and so did your interest rate.
Yeah, which is okay if it is set up front.
Correct.
And I always would rather tell a customer worst case scenario and
Right.
deliver them something
Well, and for
better.
me, that's kind of how I am, right? I'm going to be completely honest with you. I'm always going to tell you, listen, go and get a second opinion, because I might not be the lowest interest rate. You know, it might be the credit union, but here's what I can tell you. I'm going to be completely honest with you. I'm going to take you from start to finish, and I'm going to handhold you. We're going to close that transaction in less than 30 days, you know, where I don't know who you're dealing with at the credit union. So that's the price that you pay for getting a lower interest rate. But I always am up front, and I always say, you know, go shop me.
Yeah,
Here's
definitely.
a loan estimate, and that's another thing.
Yeah,
right?
Get a loan estimate.
Yes.
Get more than one opinion, but when you get that opinion, don't, if you go to an online company, which is fine, get a loan estimate so you can compare apples to apples and all the fees and all of the different things
That's
that
the
you're
first
looking
thing
at.
that I ask when I do something and somebody's telling me, well, somebody's quoting me, 3.5% or 3.75. The first thing I tell them is like, okay, go with them and do me a favor. Once they run your credit and then do everything, ask them to give you a loan estimate. Give me that loan estimate so I can compare it, and now I can tell you exactly whether or not they are charging you, or are they really truthfully just giving you 3.75 at no cost to you. And so then, like you said, we are comparing apples to apples, and I can sit down with them and say, okay, do you see this? Do you see that? Or, oh my gosh, they're absolutely right. They're not charging you anything. So that's awesome. Go with them. And I'll push them and I'll say, go with them, because I get it,
Yeah.
We're all trying to save money. We all want, the lowest payment and whatever's convenient for us.
And this is not about talking bad about other people.
No, at
this
all.
is just let's get all the facts. And I trust Claudia, so anytime a client of mine calls and asks me, so and so told me that this was true, and I say, let me call Claudia to make sure that's true.
And so, Kristen, I want to just kind of basically kind of piggybacking off of that, and because you're here, so you can definitely dispel and say, we've had customers together that don't use me. They'll go to another company, right? Because
credit union or their relationship.
But then they still come to me with questions.
I know.
It's so funny.
I know. Hey, they do that to me too. I hired so and so, the realtor, but Kristen, is this right?
I take that as a compliment, and that I am honest, and I'm going to give you all the information that you need, and then you make the decision.
Yep.
So
that brings us to the second point of streamlined VA refis.
And FHA.
Okay,
so
and
VA and FHA.
So streamlined, what does that mean?
So everybody, people have that question, like, what does streamline mean? It means that, okay, when you qualify for a loan, we're back. I don't know if it cut us off or if you heard. We should have bleeped that, right? We should have bleeped Kristen. Anyways.
I said a bad word.
I don't know if they heard it or not, but I'm just, putting it out there. So when you qualify for a loan, we have to vet you. So we ask you for pay stubs, we ask you for tax returns, we pull your credit, we check your DTI and make sure that, we're within the debt to income ratio formulas that we need to be in order to give you the loan.
Right.
Okay, so a VA and an FHA streamlined is completely different. You already own the home, you are already making the mortgage payment, but you heard that interest rates dropped, and so you want to take advantage of that because you want your payment
to be
lower.
Which is a great thing right now.
What we can do is a streamline. If you have a VA or an FHA loan, a streamline is basically we don't ask you for tax returns, pay stubs, or anything. We're basically just saying, hey, we're going to streamline you, but you cannot take any cash out. So we're basically refinancing what you owe, and we're lowering your interest rate. And so one of the questions that came up, that was kind of like, well, let me find out because I've never heard of this before, was one of our customers was looking to do a VA streamline, and he had gone to somebody and they told him, hey, we don't pull credit. Like, we're not going to check credit. We're not going to verify anything. Like, you're basically getting an interest rate and this is what it's going to be, right? I think is what it was.
They said we don't pull credit.
So he called to ask, and I was talking to him, and I said, well, we do pull credit because, again, if you remember from the beginning of this video, the interest rate completely is dependent on the FICO score that you have. Your FICO score determines what interest rate you're going to get. So if I'm not pulling credit, then how do I know what interest rate to give you or what to lower it down to?
Yeah.
And so we pull what's called a mortgage-only credit. So we'll get a FICO score. Just all we do is, okay, what's the history of the mortgage, and they will give us a credit score, and that's the credit score that we use.
So it is inaccurate to say if somebody's advertising a streamlined VA refi, that to say we don't check credit. That's not accurate.
More than likely, it's not.
So
now,
they're
again,
twisting
I can't
words.
Speak for another lender.
They're
right?
twisting words because what's going to be pulled is your credit
Only.
in a mortgage credit.
Only, yeah.
So it's just I don't like that sneaky stuff, and I don't like my clients having to dig through and to determine what's accurate. So when I called Claudia, we got kind of clear on that. But he ended up going with another company, and that's what it is,
and it's okay.
That's what it is.
But it's funny though, that they ask.
But he's asking this other company, and they're saying no, we do not check your credit.
Right.
So I think that's
Whatever
not
Credit
all the
Karma
way.
says, or whatever you
Yeah.
want to make up, to
I
get
don't
the best
think
rate.
that's
That
actually
doesn't make
very
any sense, but.
very trustworthy. But so another question I had this last week was, husband and wife get divorced. Wife gets house in the divorce decree. They've been divorced now 2 years. However, she never refinanced the house.
Okay.
Still in his name. He's on the loan. He wants to buy a home. It's been 2 years. Can he buy it as a first-time home buyer?
Can he buy it as a first-time home buyer?
Yeah.
Oh, that's an interesting question. I don't have the answer to that. I don't know. Because I know that he could definitely buy a house, right? Because we use the divorce decree to offset that. And so basically,
Okay.
if the divorce decree says the wife is keeping the house and she's responsible for that mortgage payment, even if she hasn't refinanced and he's still on that liability, like if we pull his credit
Okay.
and that mortgage still comes up.
I didn't even know that part of it.
We do not, we exclude that debt
Okay.
from him.
Good to know.
Or any other debts that are listed on that divorce decree, because sometimes it won't just be a property, it'll be
Credit card
something
or
else.
something.
But
Okay.
so we always say, okay, give us your divorce decree, and whatever the divorce decree says that the other partner is responsible for, we will omit from this person's debt. However, I'm not sure if it would entitle that person to be a first-time homebuyer. And the reason why I'm asking is I'm just using an example of like, well, what if they have an FHA loan? You can't have two FHA loans. Legally, you cannot have two FHA loans unless unless it's something where it's like you live 100 miles away or you relocated or something like that. But typically
So we don't know what kind of loan.
So
we
I
have to
will
know.
find out, and then I'll let you know, and I'll put it on the
Yeah,
on the comments for the.
That'll be great.
Because I don't know.
Because
the
there's
answer to that.
obviously first-time home buyer
programs.
benefits.
Correct.
Yeah, programs, and so we'll find that out for sure.
But usually a smart person on the divorce decree will say you have, within 18 months, you have to refinance the property in your name.
I
or
know.
within
I
a
told
certain
him
amount
that,
of
and
time.
he said, "Yeah, but you can't make somebody do what they don't want to do." So yeah, he should get his name off of that, and
Right.
because that is
because
a
what if
liability.
she stops making the mortgage payment? And now his
Or she
credit.
lost her job.
So regardless of what the divorce decree says, right now she's ruined his credit.
Yeah.
And so even if he came to me to try to purchase a home, and there's 12 lates, even with the divorce decree, his FICO score is his FICO score. So.
Good point. If you're getting a divorce, get your name off of that loan.
Yeah.
Have them refi. Yeah, so just to recap, short-term rental, if you're thinking about doing a short-term rental in Henderson, there's also a corridor down in Las Vegas area that allows short-term rentals. It's an investment loan.
Yeah.
And 20% down typically, and you need at least, a 620 FICO score.
At least, but 680, so you're getting a
Better
decent
interest rate.
yeah.
And
Look, it's Kevin.
Kevin, what's happening?
We both know Kevin.
From motorcycles.
From motorcycles. Yes.
Streamlined VA, interest rates are low.
They're good right now.
If you want to think about refinancing your home and get a lower monthly payment, definitely contact
There's
us.
also buzz now. I'm not sure that it's going to happen or what, but there's buzz that the Feds might lower the rates in August as well. So that's even better.
Well,
but
and
get
August
the ball
is next
started,
week,
right? Like
yeah.
get the ball rolling, see if you qualify.
Let's start talking about it.
A lot of people don't realize, there's such a stigma, I think it's just kind of one of those things where it's like people say, well, I don't want my credit pulled because it lowers my credit score, or they're like paranoid, right?
Yeah.
That something's going to happen to the FICO score if I have it checked. But it's good to have it checked, I would say, twice a year, because we don't know. First of all, I was a victim of identity theft and didn't even know it, right? So they start pulling stuff, and then all of a sudden they ruin your credit, and you don't even know that that's happening. Number two, collections pop up sometimes that you weren't even aware of, sometimes even medical ones. Like I have double coverage, and so I think my insurance is going to get taken care of all the time, and that's not necessarily true. And so things that you should kind of constantly keep an eye on is your credit.
Yeah.
So I would say check it twice a month, and if you are thinking about possibly refinancing or you're looking at home ownership, it's good to start probably 6 months before you even are thinking about doing it.
Absolutely.
Just in case there's stuff that needs to be done on the credit, that we could fix it, or we can work on it, or we can address it.
And it happens.
And have a game plan.
Yeah, and it happens. And Claudia and I work with people sometimes 6, 8, 10 months, a year out, because credit is not an easy fix. It's not a short thing that you just turn around and fix. And any collections take time to clear up. Explanation letters. There's all kinds of things, and we can help you through that process.
Yeah, we have a credit simulator, which is an awesome tool for us that allows us to exactly know what that person needs to do in order to bring their credit score up to whatever it is that our target.
Yeah, whatever we're working towards for you, whether it's an investment property or owner-occupied property. And again, if you have an interest rate higher than what? Think about
right now. Anything higher than 4.5%.
You have
definitely, because here's the other thing that I kind of take into consideration, right? It's your money, but it has to be worth your while for your payment to go down. If your payment's only going to go down $25 to $50 and it's costing you $3,000 for that payment to go down, $20, $30, $40, it's not worth it. But if your payment's going to go down $75 to like $100, or we're able to get rid of the mortgage insurance, then it's definitely
mortgage
worth
insurance.
it.
Yes, definitely. So if your interest rate is higher than 4.5%, contact us. Let us know so that and no obligation. We'll just tell you whether it'd be worth it or not. And Claudia will always give you a loan estimate, so you know everything that's being charged. I mean, nothing is free, right? I mean, we're all in business.
Yeah, the average cost of a refinance is probably between $3,000 and $3,500. And we do incorporate it into the loan, unless that person wants to come in with that money because they don't want their principal balance to go up, and that's an option too. One of the things that I usually tell people is, okay, well, you're usually skipping 2 months of payments, so if that 2 months adds up to the $3,500 and you want to do that, then let's do it.
Yeah, and so those streamlined FHA and VA loans, you don't check.
We don't verify anything.
Don't verify
like the GTI or anything like that, because we basically go off of what they qualified last.
Yeah,
we're just lowering the rate.
And so that would have to be you got to be living in the house. You're not pulling out any cash. They don't do an appraisal. Nope. It's just directly to lower a payment. Yeah, that's good news. That's a good option.
Yeah.
Anything else that we didn't cover?
Well, there's still, we were doing short-term rentals and we're covering VA streamlines and FHA streamlines, but just for people that are out there that haven't purchased a home, there's still down payment assistance available. There's still, sellers are very, very, I feel like they're motivated to pay closing costs for buyers right now still, which is weird because that doesn't happen in the summertime. I had a Facebook pop-up, a Facebook memory yesterday pop up that a year ago yesterday, the Hope funds ran out.
Yep.
And so that was a game changer, I think, last year this time, right? Because it was $20,000 that people were getting for free. But there are still down payment assistance programs. There's things that you can do. You can bundle. You can, use 2 things. And so it's definitely, and interest rates are still pretty low compared to the overall historical, interest rates.
For sure. I was thinking about this the other day. My mom was telling me that 1984 we bought our first house
12,
in Green Valley. It was something like 11 and some change. 11%.
My first home was 6.75% with Chase Bank, and I thought that was an amazing interest rate.
Yeah. So historically, you're right, and the market has shifted, and we've been working together for the last 4 years, and it's been seller market. Buyers can't even get houses. It's equaling out now. More inventory on the market.
Yeah, last year this time was it like 2.5 weeks of inventory. Now it's 2.5 months.
Yeah.
Right? So that for the borrower
is good.
Is a good position
thing
to be in.
Yeah, absolutely.
So don't forget about that either.
So there's options. So contact us if you just want to chat about what's available for you.
Yeah.
I want to say one more thing. You had mentioned what customers should check their credit twice a year.
Right.
People ask me all the time. I use LifeLock.
Oh, okay.
I really like it. They show once a month. They send me a statement. Now they only check one of the FICO score. They check all 3 once a year, and every month they give me only one of them. But
usually
Credit Karma.
Well, usually if you call one of the 3, Equifax, TransUnion, or Experian, once a year
they'll
give it to you for free, and it doesn't affect your FICO score.
Okay.
Like it's not, like a hard pull where they're like,
yeah,
your interest rate is dropped. I mean,
So-
not your interest rate. I'm sorry, your FICO score is dropping.
well, put that on your calendar. It is important to see. Like I had moved earlier this year, and one of my utility bills
Yes.
it was on my
They go
credit.
on
It
there,
was
and
like a
something-
$40 trash
The
bill.
first thing I ever hear from people when I do that are like, nope, I didn't have that, or I didn't even know that
I
was
didn't
on
even
there.
know it was there.
Mhm.
And so I had to get that cleaned up. But anyway, so the best way to go about checking your credit score, number one, once a year, would be to go directly to one of the big three.
And then just say you want a free copy of your credit report.
And then the
they will do it.
second time would be to do what? Credit Karma or
Well,
any of
Credit
these
Karma's
free?
usually not super accurate.
Yeah.
And they only give you 2. But that kind of gives you a good general idea of where you're at, right? So if you start seeing that your Credit Karma scores are dropping or whatever, hey, pay attention to that and say, okay, why is it dropping? What's going on? But I would not argue with somebody like, so if you tell me, because that's one of the questions that I ask, like, okay, what do you think your FICO score is at before I even run it, right? To see if we kind of start pre-qualifying them without having to pull credit. And they'll say, well, on my Credit Karma, I have this and this. And so I know pretty much that it's going to be off by about 10 to 15 points, give or take. And so if your Credit Karma's, good, then you kind of know that, okay, I'm good.
Yeah, but I've seen scores, all three scores, be way off. Some 70 points difference, right? That's why you take the middle one.
Right. So because some creditors will report to only one bureau, some will report to all 3, some only report to 2, and so that's why it's off, right?
Yeah.
That's why Credit Karma is off, because they only report 2, and I don't know if they take everything into consideration, and then it's also not the same credit report that we're pulling. Remember, Credit Karma is based kind of more, I think, on credit cards. We're doing mortgages, it's like a higher risk. It's a higher,
higher dollar
I
amount.
think we had discussed this in a previous video where there's different credit reports that different entities pull. Credit cards pull their own, and it's I don't know, credit report 8 or something like that, and then you have finance companies that finance cars, and they have their own, and then we have ours.
It's such a mystery, isn't it?
It is a mystery.
It's like
It is. But unfortunately, here in the United States, if you don't have a FICO score, you can't finance anything.
Yeah, I mean, cash is king. I love paying cash for things, but guys, when you know how to use your credit responsibly, it's a real huge benefit to have good credit.
For sure.
Yeah, so if you want some direction on that too, we've been doing some credit videos. We'll do some more of those too, but if you have any questions, let us know. Thank you.
You're welcome.
It's good to see you.
It's good to see you.
Have a great day,
Bye.
guys.